So are Bank on Yourself policy loans just a huge ripoff? I mean, are they really just a sneaky way for the life insurance company to rip us all off for accessing our cash value and then paying interest on our own money? I mean, for goodness sakes, that's what radio hosts love to claim all the time about Bank on Yourself type policies. So it must be true if they say it on Google and on the radio, right? Of course, I'm being facetious. And what I hope to do with you today is to dispel the myths of exactly how the policies work and how the Bank on Yourself designed policies truly work in your favor when you borrow and access the cash value in your policy. So, my name is Mark Willis. I'm a certified financial planning professional and a Bank on Yourself professional. And I can't wait to get to the bottom of how policy loans really work. So let's jump right on in. First, I'm going to show you conceptually how the loans work through a whiteboard. So let me do that now. Share my screen with you. And this very simply is how the loans really work when you borrow against a life insurance policy. Now, let's say you want to do something like buy a car. So I'm going to draw a little car here. All right, that's supposed to be my car. Hopefully we can see that there. And I'm going to give this guy a little, there we go. All right. So we can do car purchases a couple of ways. We can go to a bank down the street and maybe the car, let's just simple math. Let's say it's 10,000 bucks, nice used car, something small like that. And we borrow the $10,000 from the bank. So they're going to hand us 10 grand. And what are we? Now we're in debt, aren't we? So we're under the $10,000 limit. We got to climb our way back up to debt free. And we'll end up paying those guys interest out the back door. So the cost of the car might be 11,000 bucks over the course of whatever 3-4 years. And what do we have to show for it at the end of that loan period? All we have is a big fat zero on our net balance sheet and an old car that we probably have to trade in. So we don't want to necessarily go the bank route. That's why we're looking to bank on ourselves, right? So maybe a better pathway would be to save. So saving in our bank account allows us to earn a little bit of interest. And let's say we've done the right thing and we've lived within our means and now we've got $10,000 in our savings account and we're ready to walk in and pay cash for that car and we're feeling pretty good. But what happens when you withdraw money out of a bank account? How much interest are you now earning on this money? Well, of course, zero. We're breaking compound growth every time we make a purchase. And we only can start earning interest again slowly as we save money again in that savings account for the next car. So we're tied down when we pay cash. We're really just passing up interest we could have earned on the money had we not bought the car and left it invested instead. That's the trouble with paying cash. Truly, you finance everything you buy because either you pay interest to a bank or you pass up interest you could have earned on that money. You're financing it from your future self. You might think of it that way. So let's get rid of paying cash and let's talk about how the loans on policies look and how the cash flows. So with a life insurance policy, it looks something like this: a cash value bucket and a death benefit bucket. And everyone's going to have different numbers, but let's say you could access $10,000 worth of cash value at this time. And let's say that because of your age and health, your death benefit at that time is $250,000. Now, guys, in the real world, the policy would continue to be growing. You'd be adding premiums to it. But for simplicity's sake, we're just going to look at this $10,000 for this example today. We just want to buy that car, okay? So instead of withdrawing this money, which you can do, you can always cash out, walk away from your policy and take that cash and go buy your car. You can surrender your policy or withdraw the money. But rather than doing that, because there's no real benefit long-term to doing that, rather let's use this cash value and freeze it, use it as collateral. And we get access, because we are policy holders, we get access to this life insurance general fund known as the pool. And this pool is a large bucket of money. It's literally tens of billions of dollars large. And they're out there using the money in the world to get yield on their investments, et cetera, mostly fixed income, real estate, bonds, et cetera. And they're getting interest and growth on that cash. And they look at your request. You send in a loan request on Tuesday. And usually by the end of the week, they've been able to look at your cash value, say, yep, you know, Sam Smith's got 10 grand. He's good for it. We'll use his cash value as collateral we'll take a little slice out of our pool here, and we'll send Sam Smith a direct deposit of $10,000 directly into your bank account by the end of the week, usually Friday of the same week. And you can be walking into the car dealership and paying cash for this car. Now, a very important question. Did this cash value leave your account, or is it still in there growing? Well, the money came from the pool. Your cash value is still earning growth and interest as if there was no loan against it, because we're just using this cash value as collateral. The money came from the pool. Your cash value is still whole. It's still earning dividends even on the capital you borrowed. And you're driving your car around town. Not too bad. So that's it. Now, if you were to do this, say yesterday, and passed away today, your family would get the car, of course. They'd get the title on the car, etc., because it's yours. You own that car. There's no other bank with lien against it. But you have a loan against your life insurance. So they would get the car, and they'd get minus $10,000. They'd get $240,000 as a death benefit. And this is why the insurance company is so willing to offer the loans in the first place, because they know for sure that either you're going to pay back this loan during your lifetime, or it's going to be deducted from your death benefit when you pass away. So that's a self-collateralizing loan. That's a fancy way to say that. So let's go through the rest of this thought process. Then we'll look at some numbers. For those engineers on the video, hold tight. We're going to get to some fun numbers. So let's say that you were to pay back this loan on your schedule. Okay, so the loans go back to the pool as you pay the policy loan off. This is something that too often gets misinterpreted on other YouTube and podcasters out there. You don't pay yourself back. You're paying the policy insurance company back that you have a policy with. And at this current time, there's a loan interest on the pool. And most companies, it's going to be at a 5% simple interest, compounded annually in arrears. Hold that thought. We're going to come back to what that means and see some real numbers eventually. But for sake of simplicity, let's say that you decided that you get to pay that loan off over a 4-year period. So that's pretty cool. You're in control of paying this off over 2 years, 5 years, never. Again, if you never pay it off, it's just deducted from your death benefit. So let's say it took you 4 years to pay this loan off. That, just to keep the math simple, would be a total loan interest of $764. Okay, so that's the interest paid. Now, what happened here? We had a car that was worth 10 grand. That's what it said on the sticker price on the windshield. But somehow you got snookered into buying this car for a total of $10,764. Who in their right mind would do that? Why is that a good deal? Well, think about that for a minute. Where did this interest ultimately end up? Well, it went back into the pool. And who owns that pool? Well, that's right. If it's a mutual life insurance company, you and I and any other policyholder own the pool. And therefore, in essence, we are owners of the insurance company. And therefore, any profits that we receive, whether through bonds or policy loan interest or anything else, comes back to us at the end of the year in the way of dividends. Of course, those are not guaranteed, but usually the companies that we work with, we want to make sure that they've worked and paid a dividend every year consecutively for 100 plus years. So this interest, along with everything else, comes back to you indirectly as a form of a guaranteed cash increase plus dividend on the policy. Now, here's where one little piece of math is involved. So these policies can be doing anything in the realm of middle single-digit returns. So let's just, for sake of simplicity, over the last 60 years or so, the real internal rate of return of these policies have been anywhere from 4% to 6% after tax, after fees, etc. So for simplicity's sake, I'm just going to say let's do 5% over time. So at $10,000, doing 5% interest over 4 years, the growth after 4 years on $10,000 would be $2,155 of gains. That's your gains on 10 grand. Now, the interest we paid. Now, by the way, this is way better than a savings account, I'd say. If I'm looking at my options, I would absolutely pick a whole life policy in terms of a place to store wealth over a savings account. However, there are some costs. Anytime I borrow against this policy, it's not a free move. It's not free money. I did pay $764 to buy that car. That was the interest charged. Now, with that in mind, what was my arbitrage? Let's do the math there. By the way, $764 is not 5% compound. We'll get to that in a minute. But first things first, our arbitrage, our fancy way of saying the benefit to you, was $1,391. Arbitrage. If I had just paid cash for this car, I'd ended up with $0. So which of these two numbers would you really rather have? The car's the same. You're still driving the car. In both cases, whether paying cash or using the policy loan, you get to drive the car today. You get to use the car today. You own title to the car. There's no lien against the car. But in one case, you walk away with a lot more wealth. And with the other, you've lost all the growth on your money. Now, add a zero to all these figures and think about how this might work in real estate. Add 2 zeros to think how this might work over your retirement. The concept holds true, whatever the size of the numbers on the screen. So hopefully this illustration makes sense, but I'd like to talk through a real loan with some actual numbers. In this case, here's a loan at 5%, simple interest, again, compounded annually in arrears. So what does that actually look like? In this case, a person takes out $1,200 in the first year, in the first month of the first year of his policy, and he makes a $100 payment each month over the course of that year. Okay, what do we notice about the loan balance? As you're going down the page, notice that the loan payment is reducing the remaining balance exactly dollar for dollar. In other words, there is no servicing of interest all year long. That's what simple interest is. It does not compound on itself. You're not having to constantly service the interest when you borrow from a simple interest loan. It's a tremendously advantageous way to access and borrow money. I mean, really, guys, I wish our student loans worked this way. I wish mortgages worked this way. We would all be much better off as borrowers. If we're going to have to borrow, it's always better to use simple interest terms on your loans when you're borrowing. Now, you want compound growth when you're lending, when you're the guy or gal lending or investing money, you want compound growth, which is what the policy does. So when it's time to grow your wealth, it's giving you compound growth on your cash, compounding, even on the capital you borrow. But the contracts of the insurance companies I recommend for Bank on Yourself offer a simple interest loan when you borrow against the policy. So back to this number here, one last time. If you did the math on that, $764 divided by $10,000 over 4 years is not 5%. It's only 1.9% APR. Not too shabby for borrowing cash. Not too shabby. So in this case, we go all the way down the page. Now there is interest earning. It's accruing, but it's not compounding. Notice that. So we're accumulating interest, but it's not compounding all year long. It's like a zero interest loan all year long. There is interest accruing. At this point, at the end of the year, we've accumulated $27 of interest. And if you did the math there, the real APR, even though it was a 5% interest rate, your real APR was only 2.3%, which is pretty affordable in my book. So I'm very pleased with the loan rights you have in the contract of the companies that we would recommend. Let me do one more round here for those who are engineer inclined. What if you don't pay any of the loan back? Some people ask me that question. So here's a real life example. Someone starts a policy in month 1, and then by month 2, they borrow out $1,000 and they make no payments for the rest of the year. Now, even though they had 5% earning on their money as a loan rate, it is a simple interest. Notice how the interest is not getting bigger. all year long. It's a flat interest rate. And because it's a simple interest loan, 5% is not always 5%, the theme of our video here today. In this case, $45 divided by 1,000 is only 4.58% because it's simple interest all year long. That's a tremendously powerful tool in the bank on yourself type policies that we offer. What about if you do pay back the loan in full before your policy anniversary? What kind of numbers does that look like? I put this in green, and this was due to the great help of Debbie Wilder, another bank on yourself professional who built this. And it's in green because this is kind of your best numbers. This is the best case scenario, you might say. In other words, when it's simple interest, the faster you pay off the loan, the better off you'll be. So here's someone in the first month, no loans taken. Second month, you request the loan, but no loan payment. So that's pretty cool. Again, reminder, you're in control of how and when you pay back these loans. But let's say in the third month, you start making a $100 a month payment, and it comes all the way down to $0, where the loan balance is zero at the end of the year. The grand total of interest accrued is $23.13, which works out to 2.3% APR. Pretty phenomenal. Let me come on down here. What if you don't pay off the loan before your anniversary and yet you smartly pay the interest? So one of the neat features about these loans is if you have a loan balance at the end of your policy's anniversary, the insurance company will send you a letter in the mail saying, hey, Sam, we noticed you have $77 of loan interest that we want you to either pay or ignore. What do you want to do? Do you want to pay the interest out of pocket? Or do you just want to ignore this letter? If you ignore the letter, we'll simply roll the money, we'll compound that interest once a year in arrears onto your loan balance. And that's what's happening here. So in this case, Sam Smith or whoever is paying the interest out of pocket. That's the smarter way to go. If you're going to carry a loan balance across a policy's anniversary threshold, then it's better to pay the interest at your policy's anniversary, as this person does. So in this person's case, we've only been paying $50 a month, and that leaves us with a $500 loan balance at the end of the policy year. And so what's happening here is we pay our $34 and we have a 3.43% APR in year one. And notice there's no compounding on our loan balance. It's simply wiped clean. We get the right and opportunity to wipe clean any loan interest, and it never snowballs against you. Again, call me if you know of a mortgage that does anything like this, because this is phenomenal. And in the second year, we have a 1.9% APR. Now, if you were to average these two numbers out, that'd be in the 2% range, right? 2% something. So I'm very pleased with the overall APR of this policy loan. But there's one more option, and then we'll wrap up our video. What if I don't pay back the loan in full and I don't pay that loan interest? In this case, the same person doing the same monthly payment. In this case, he's still got that $34 at the end of the year. But in this case, in this gentleman's case or lady's case, she or he just lets the money compound at the start of the 13th month. Totally fine to do that. Absolutely within your rights. Because recall, your policy might have given you $800 of growth on this money, let's say, depending on your timeline and the cash value in the policy and whatnot. So there's always that positive arbitrage. To kind of go back to this whiteboard again, there's always that positive arbitrage there. But in the event that you don't have $34 you can scratch together from the couch cushions to pay toward this loan, it'll simply roll right onto the loan balance once a year. This is a way for the insurance company to offer loans in a way that makes sense for them. And remember, who are them? They are us. Sorry for all the bad grammar there, but when it's a mutually owned life insurance company, we, in essence, are the owners of the company that just charged you $34. And in that case, it was a part of the overall growth and dividend of the policy that you own. So at the end of the year, this person is able to wipe out that loan. Notice it's a slightly higher APR in the second year than it would have been otherwise. So it's always a little bit better to pay your loan interest once a year if you can. Now, if you're bored to tears on all these numbers, don't worry. When it comes to the real world use of this policy and the loan feature on this policy, it all just kind of works. You don't have to be, a engineering specialist or a nerd with Excel like I might be. All you need to do is look at your policy's loan value, log in, see what you got in cash value, and then request the loan. Within about 4 or 5 business days, the money is directly deposited into your bank account, and it just works. You just get the dividend checks, or you get the dividends applied to your policy at the end of the year, and you just set up a payment plan that makes sense for your policy with your control in mind. You get to decide, am I going to pay this at $50 a month, $100 a month, $10,000 a month, wait 3 or 4 years and then pay it all off, never pay it off and let my death benefit wipe out the loan at the end of my life? That's what it means. And that's the power of becoming your own source of financing. So guys, I hope this video was enlightening. I hope it was encouraging to you. And let me know if you have any questions. Put some notes down in the comments. Be sure to like the video. Let me know if you like it. And let me know if you don't like it. I'm up to that too. Not afraid of that. So give me a shout either way. Let me know if you'd like more videos like this. And be sure to subscribe to the channel so I can always get in front of you and let you know what we're thinking about and what we're learning over here at Not Your Average Financial Podcast.